And what a great panel to actually start off our session here. And again, I think words of caution, encouragement there coming from Noel there. Be brave, all of you. You have to take that chance. You actually at times have to take a risk as well, because there's so much to play for right now, so much going on in the industry, and so much that you absolutely positively have to do. I think we heard from just about everybody there really, really committed to this journey, and again, about defining what that journey is. I think without a doubt, we all know where we're going. But unfortunately, I think the conversation probably has been focused on where we're going rather than how we're going to get there. And I think now we're seeing a bit of realism come back into that conversation. The narrative is definitely shifting. We have more voices on board. And hopefully we'll actually put a little bit more thought process into how we're going to get there and make sure that it is a win-win for everybody. I believe we're ready for our next session. So let me get our panel members up here. Investor-tested strategies by doing well, by doing good, also in search of alpha. So I'm going to be joined online here, or online and in person. How nice to say that. The Global Head of ESG for Invesco, Catherine DeConnick-Lopez. Lovely to see you. I believe we're going to put you over here. Bertie Whitehead is with us, and Bertie, the Managing Director for UK Investment Banking at Goldman Sachs. Bertie's in my chair. What on earth will I do? Shocking, shocking, shocking. And wonderful also to have Oliver Phillips from Standard Chartered Bank here, Sustainable Finance Director. Again, we're going to continue the conversation, probably a little bit about what you heard. And I hope you're very encouraged in terms of what you did hear. And Catherine, perhaps if I might start with you, doing well by doing good. The search for alpha, there's many interpretations on this. How does Invesco look at the ESG value creation particularly?
Absolutely. Thank you, Eithne. We are looking at ESG from a sustainable value creation perspective. So it's all about our investment teams really thinking about ESG integration. We have a target of 100% ESG integration by 2023. We do recognize this as a journey. It does take time. It requires tools, systems, and then solutions, and obviously partnership with our client stakeholders and the wider society as well. So we are thinking about it in a very holistic way and are really on this journey.
And we even heard that in the last panel, that it has to happen. But Bertie, when we look the search for alpha, we look around at the markets in the last couple of weeks. We don't have to look too far back. I sometimes wonder, are we looking for a search for survival right now? So yes, we want alpha without a doubt, but how do we look and sort of build recession-proof investment? Or is that even possible now? Keeping ESG in mind.
Keeping ESG in mind, as always. I would say this is very much a kind of long-term investment process rather than a week-by-week. Yes, of course, in the last couple of weeks, we've seen markets go through a bit of turmoil. What's really interesting for me is even in the last couple of weeks where we look at the fund flows, yes, we've seen huge amounts of fund flows out of global equities, but very, very little out of ESG funds. It's all non-ESG funds which are seeing the outflows rather than ESG funds. So we're continuing to see that proportionate contribution of ESG funds increase over the last couple of weeks.
That's very encouraging, and I think, given to see, even talk to the big players and the fund allocation people, even in our last panel too. But we have to look to the future on that. Talk to us, Oliver, if you would, about sustainable investment, and does it actually mean that, we might have to sacrifice some returns? Because I think people look at that, particularly when we're looking at climate risk and indeed, the impact on valuations in the longer term.
I think that really is the common perception that an ESG investment is not as good an investment and you're going to give up those returns. And certainly when I'm talking to my clients and about some of the transactions we're looking to structure, I think one of the first 5 questions is going to be, how many basis points will this save me? But the reality is that we've seen that it's not the case. So we looked at our own sustainable finance book, and we compared the sustainable finance sort of returns on a risk-adjusted basis and the rest of the book, and the sustainable bit was better returning. So it was actually better business for us. And I think that's kind of the trend that we're starting to see. And when you look at the long term, you think of the risks from climate coming in, that's only going to increase, particularly if you've got a sort of long 10-year plus horizon in terms of some of your kind of more infrastructure-based investments.
And I think that's so encouraging to hear. Catherine, when we look about, ESG integration and engagement, particularly, in terms of making better informed decisions, as that source of value creation. Talk to us a bit more about, the data that's helping everybody make those decisions.
Absolutely. Well, Invesco in 2021 recorded over 3,000 company engagements on ESG. So having that dialogue with companies and having that engagement with companies is really important because, this is about moving forward together. But obviously, to have an informed dialogue, you need good data. And so we created our own ESG rating system, so really an evaluation of company performance on ESG issues. And we did that because an off-the-shelf solution we felt wasn't going to give us enough insight and that holistic perspective we were really looking for, and importantly, really targeting those really material issues per company. So we're now able to drill into our companies, and that has really been driving forward that increased dialogue and engagement with companies.
And again, I think we have to look at the measurement that's out there, and we can maybe hopefully talk a little bit about that later. But Bertie, there's still a lot of challenges out there for some companies in terms of actually getting access to capital. And talk to us perhaps a little bit about, capital flows. What do companies need to really be doing?
Sure, and so I'm going to divide, if I can, between the listed companies and the unlisted companies. So for listed companies, they are by and large getting access to capital that they need. The equity markets are functioning, the debt capital markets are functioning. They are discriminating, as Oliver was saying, between those who are perceived to have a longer duration of growth and better kind of quote-unquote ESG potential. On the private market side, we're beginning to see development as well. So we're beginning to see the private equity firms really pivot their asset gathering exercises into the more greener side of the equation. So using kind of EU speak, the kind of Article 8 funds and Article 8 plus funds. So they are absolutely in asset gathering mode and focus there. One of the big challenges that we're facing is a lot of the really exciting projects that are coming are projects. They're big solar parks, they're big developments. And that's a challenging area to find finance for hitherto because there isn't a revenue track record. So the kind of the classic VC, private equity, crossover investor who wants a revenue track record can't point to that. But at the same time, they're going to be building this huge store of value, which will be generating revenues in kind of 5+ years' time. So how do you finance that today, where there's a lot of initial risk? And that's one of the things that we spend a lot of time thinking about, trying to make sure the various different bits match up. And I think it was mentioned on the prior panel as well, kind of a little bit of kind of demand pull, so that you can then get the supply coming through.
Oliver, when we just, following on that, some data is not available. How do we actually make decisions? Where do we get the data? How do we look at the measurement, the standardization, all of that? I mean, there's huge pressure for everybody, I think, to move forward, to move fast. We heard Noel Quinn say we might fail a bit along the way. We've got to just pick up and move again. So, how can we actually get it right? I mean, is it possible at the moment? I mean, we ultimately have to get it right, but we might make a few mistakes.
I think the data question is really important. Data for any investment is key, whether it's financial, whether it's ESG data. I work with companies in Africa and the Middle East, not necessarily the most forthcoming regions in terms of disclosure historically. And getting that data in a form that you can use is really important. And that's why I think you're going to hear more about this later, but the tool that FII has developed with the support of EY and some others of us who have been chipping in some ideas, is going to be really exciting, being able to kind of contextualize that data, to show what does good look like in a particular market, rather than sort of trying to compare a company in Africa to the baseline in Europe, which doesn't give you any meaningful comparison to actually find, what is that really important and what that sort of most positive ESG investment that you can make.
And again, I think, Catherine, let's have a look at, particularly carbon-intensive industries and, the characteristics of different asset classes. Where's the trade-off and how do we look at that when it comes to risk, return, and carbon intensity?
Yeah, no, thank you. So I think, look, recent markets have obviously shown that for particularly very thematic, very focused strategies, such as a clean tech strategy right now, has been impacted by the current market movements. What we have seen, and certainly in our strategies, is that a broader perspective, so say like a sustainable emerging market fund, say, wouldn't necessarily underperform, and that is even when it's carbon optimized. So if you have a broader diversification, you can diversify while optimizing for carbon risk in a structured way, and I think we've seen some success with doing that. And for example, in one of our strategies, been able to lower the carbon footprint so that the strategy became in line with, say, a 2-degree world as opposed to previously a 4-degree world, just through carbon optimization, but with the same risk return. And that's been, really powerful, because obviously, there are many clients that don't want that trade-off, right?
And I think the body of work that's been done to actually help inform clients. Bertie, we talked in the other panel about it's not just about the environment and it's not just about climate. We're looking at S, we're looking at G. And let's take, just because it's all happening, a quick look at geopolitics and the impact on ESG. And probably something that wasn't in the rule books, and how many companies just stepped up and said, we're not doing this.
I mean, it's a fascinating question, because I think what we saw in the last 2-3 months has been ESG in real life, which is companies choosing, particularly Western companies, choosing to examine their exposure to certain countries. Are they happy with those exposures? And you saw leadership at the start, where a number of companies said, actually, I want to exit Russia, Belarus. Then you saw societal and indeed consumer pressure coming through. There are a couple of automakers where they started getting action put on them, and tweets and Instagrams and all the things I don't understand to do with social media, putting pressure on the companies, and then that was changing their ways. So this is kind of real life action of, can I preserve value through values? And a lot of the decisions were being made was, actually, it's better for my standing as a company to listen to what my customers want, to listen to what I feel as a company, and exit for more reason. And actually, in many instances, is well reported at kind of significant cost to the company, but overall preserving market value in their view.
And again, it was swift action that was made, swift, loud, and I think leadership came in there. Probably what Noel talked about, taking the risk. One other area too, when we look at ESG for good, yes, we want to make money on this. But also, and I just heard the president of Angola recently say that saving the planet shouldn't bring more hunger and misery to people who continue to depend on their hydrocarbon revenue. And he came out very, very loud at a conference recently on this. Because on one side, yes, we have so much to do, but we can't then destroy societies at the same time. How do you balance that?
I think this concept of a just transition is one of the most challenging to tackle, to be honest. It's something that as an emerging market bank in Africa, the Middle East, and Asia, it is core to everything that we're doing. We produced a study recently called Just in Time, and we've worked out that to get to net zero, and we're looking at net zero by 2060, not even net zero by 2050 for this, there's a $95 trillion investment gap that emerging markets need to get there. And we looked at some of the financing ways of that, and if it's self-financed through taxes and borrowing, that's going to have an impact of about 5% on consumer spending in those countries, 5% per year. And we've looked at some of the costs, and that could be as much as $2 trillion per year globally. If developed markets come in and actually support that, and they're the ones providing the funding, household consumption is going to go up 4.5%, and you're going to have an increase in global GDP of around about 3%. So you're actually seeing it being a net positive for developed markets to play that role, to support that transition in a just manner.
And I think a lot comes down to this concept of, a just transition, whereby sometimes I think sitting in London, it's very, very comfortable in many ways. People are worried about the end of the day, not the end of the world in so many societies. And I think we all have a duty, and all of you, particularly in the financial market, have a duty to that. Catherine, talk to us when we look at the concept of, real assets as, we knew them. For the most part, we look back, and even, the Industrial Revolution, everything that makes our manufacturing work, all of that too. How can one, I suppose, mix and match to a point whereby we can have a balanced, low-carbon portfolio, or do you just shy away from it?
Well, I think that that's a great question because this whole concept of net zero has come to the fore, and I do think that the kind of the focus so far has been on, say, more traditional public asset classes, listed equities and fixed income, and I think as Bertie rightly said, I do think there's a huge opportunity in the private market, so in real assets, but also private debt, et cetera, to really influence change and be very direct. In the case of loans, partners with issuers that perhaps are distressed. For example, in one of our strategies, we were able to support a loan. Actually, as a Goldman Sachs as a partner, and this is an adaptation type issuance for a forestry solution now in the United States, but where you're seeing increased wildfires, etc. And so adapting to climate change is what's really going to be coming to the fore going forward. And being able to support better forestry management, better ways of adapting to climate change is really important, say in real assets, but also in the private real estate.
Now, Oliver, you mentioned a lot of focus from your bank, particularly on emerging markets. But how do you, I suppose, what's so different in terms of your approach to? Is it sort of emerging markets versus developed markets, or are you managing to do both?
I think we do manage to do both. I mean, obviously, our history as a bank, for most of these countries, we've been in there for the vast majority of the 160 years that Standard Chartered has been a separate entity. But I think you need to realize that one size doesn't fit all, even within developed markets. And actually, you need to contextualize things. You need to look a little bit outside the box. Think of some of the things you can do on the structuring side, bringing in carbon credits and monetizing those, for example, looking at blended finance, export credit agency cover, some of the sort of more kind of philanthropic development capital and bringing that in to play a role is really important in emerging markets to change the risk perspective so that I can get a maybe less emerging markets focused bank to come in and play a more significant role in those transactions, because it starts to stack up something that might be more familiar to look at.
Talk to me a little bit, Bertie, about the role of government. And we just heard that there should be more role. Should they be? Can they be? An encourager? And they should be. But is there a danger that they can also be a hindrance? Where's the sweet spot for government?
Wow, that's quite a big question. So. We've had a lot of leadership in Europe already in terms of regulatory push. I would also say that in Europe we've had a lot of pull from the asset managers as well as corporates wanting to do it. In the US has been less, so we're now beginning to see some push coming through. There needs to be a balance because over-regulation typically then stifles innovation, stifles capital flows. The fascinating thing for me though is just being, I guess if you go back 2 years into COVID and to today. So we've gone from a period where, particularly in the Western economies, has been historically a kind of resistance to big government making big changes. Now, COVID just blew that out of the water. So you had lockdowns, you had people being mandated. Now what
they took swift action, and there was a little opposition maybe, but for the most part, no.
For the most part, no. And now we're seeing, even post the Russia-Ukraine situation, big changes getting made and being accepted in terms of energy policy, LNG policy. Things which would typically take 10 years are happening in weeks now. Now that is a massive shift in the last couple of months, which I think is going to really help the energy transition move forward at pace.
And again, it should be encouraging to make sure that people come on board. Yeah. I think, the decisions that are going to be made will be long-term, but again, making sure that everybody can do something practical. Yeah. I think, they've really looked maybe a little bit better. Catherine, again, staying with, emerging markets, developed markets, and perhaps, could you give us maybe an example of some of the work that you've been looking at in emerging markets that's perhaps different in terms of how you work?
Well, I would say in India, for example, we were one of the first to launch an ESG fund. So we have with our Indian team, very exciting, based on our proprietary research methodology and insight that the India team provides. We were one of the first to actually do an ESG fund there. I think since actually the policymakers have seen increased interest in India in terms of ESG issues, disclosure, stewardship, etc., has come to the fore in that market specifically, which is, I think an illustration of what we're seeing more broadly in emerging markets, actually a really strong interest in, both setting the framework and then providing the actual specific solutions. And we're a partner in that. We want to play in that. And so, seeing significant opportunities there.
Oliver, how can financial institutions, I suppose, get more creative? And perhaps creativity wasn't a word we might associate with financial institutions. But again, since things are shifting at such a rate, how do you catch up with that and make sure that there is more flexibility to make sure the funds are there?
I think there's a lot of potential for that. I mean, we as a bank, we structured the first social loan in Africa for the Republic of Ghana, talking about just transition. That was financing a road project that was going to connect rural communities into the major cities. Not necessarily the most green investment from a social point of view, really, really impactful. The thing that I'm most excited about, though, is when you bring in that sort of monetization of carbon credits, which I mentioned briefly earlier. We've started to incorporate that into a few things. We did something with Etihad Airways back in 2020, which was a sustainability-linked bond, or sukuk even, where instead of the investors getting more, actually the company said, we're going to go out and purchase carbon credits. But we're also looking at things where projects are going to generate a carbon credit or an amount of carbon credits. You sell those to investors, to other companies, and use that to reduce the interest burden that companies are going to pay. And for sovereigns, in particular in Africa, where there's such a focus at the moment on that debt burden and on the sort of the crisis there, and we see it in Sri Lanka most recently, of course, that actually, if you can use that and bring around sort of a new source of revenue that's going to be funding that interest payment, your interest burden looks very different and hopefully frees up some capital from the sort of traditional income streams of the government to then go into other areas and support kind of other important steps that they need to take.
We have so many areas that we're not going to be able to delve into in this panel, but throughout the day, I think we have just about everything covered. I'm very excited about what we're going to talk about. But wrapping this up one, Catherine, in terms of perhaps, that words of wisdom, words of warning out there, there's so much happening, it's happening so quick. Leave us with an inspiring thought for the day.
Thank you. Well, I think for me, where I'm seeing the market growing is really around action. Like, take action. This is hard. There are lots of complexities. There are lots of questions, I think, in everyone's mind. But I think if we keep questioning, keep asking for more information, now education is important, but I think just taking the small steps to make the first inroads teaches everyone a lot, and, not be afraid to fail, right? Just take action and get on the journey.
Oliver, again, creativity is needed, risk is needed, bravery, leadership, all of that. A sort of call to action to the industry. What can we do? And what can we do practically, before the year is out, perhaps?
I think COP26 in Glasgow last year was great. We saw a lot of statements from the developed markets saying we're going to support emerging markets, particularly Africa. We saw a lot of talk. The action hasn't yet followed, and action, I think, really, really is key. We have a great opportunity with COP later in the year in Egypt, in Africa for the very first time, to drive that forwards and to actually see tangible commitments, and not just saying we're going to allocate this amount of capital. And that's the public sector and the private sector as well. We need to do that too. But start showing that you're taking steps, you're deploying into these projects. And there are so many projects. There are so many great companies that are not, the projects, as Bertie was mentioning, but the companies are doing lots of different small things that are really exciting and facilitating the ecosystem. And that's what we need to be supporting and actually delivering on those commitments.
Bertie, I'm going to leave you the closing word on this one. So a little pressure on it there. Again, we have a good few months left in this year and a good few months till we, get ready for COP. What do we need to be doing?
Well, if I may, Eithne, I'm going to do something relatively dangerous, which is disagree with one of your previous statements on the prior panel, where you said it was win-win. It's not win-win.
You don't think it can be?
No, there will be losers if you're not adapting your company. If you're not moving quickly, you'll be out-competed. And so you should think about this not as a box-ticking exercise you need to do. This is a survival exercise as well as a thriving exercise. If you don't get it right, then there will be some casualties along the road. So think about it through that lens. This is a commercial imperative for you to adapt.
And are you encouraged that people are heading that direction, or are you
Yes.
concerned that maybe there's a few that aren't doing it fast enough and think, oh, maybe later, or maybe a diluted version?
I come from a bank where it's a culture of you can never do enough. There's always continual improvement. So I think that some companies are doing fantastically, but there's always more to do.
Okay, and again, that call for action, I think, will be heard loud and clear, particularly after we get through the day and keep everybody, engaged, informed, educated, and hopefully inspire you all throughout the day. Thank you all so much. Catherine, thank you for being with us. Oliver, Bertie, thank you so much. A big round of applause for my great team here.
Thank you.
It's been super. Thank you so much.